Hello everybody, welcome to Monday Morning Must Knows. My name is Merlin Rothfield, and here are 3 very important things to pay attention to for the upcoming trading week. Now, as usual, we'll start things off rather slowly. We're going to start off with the earnings calendar. Now, why is this important? Well, as you saw last week, we talked about the importance of retail sales with their retail sales numbers and all of the retailers reporting earnings. And lo and behold, Target misses, Walmart misses, and a slew of retailers miss earnings, horrible retail sales numbers. And what happened in that market? Boom, down periscope, and it looked real ugly going all the way into Friday's close. We'll see what happens starting Monday morning. Now, let's look at the calendar itself to see which companies are reporting, and I'll give you a hint. Everything in red is considered a retailer, and there's a bunch of them. Now, we go from, I think we had last week like 389. Now we're at 300 companies reporting this week. You have Advanced Auto Parts and Zoom, which has been a total bloodbath of a stock. You have on Tuesday, Best Buy, Abercrombie & Fitch, Nordstrom's, AutoZone, Urban Outfitters, and Toll Brothers, the home builder. Wednesday, you've got Nvidia and Dick's Sporting Goods. Thursday brings you Macy's, Costco, Alibaba, Baidu, Marvell Technologies, and Ulta Beauty. And on Friday, you've got Big Lots and Canopy Growth. Now notice a lot of companies in red there, signifying retailers coming out with earnings. So, given the fact we had so many A-listers, Target and Walmart, miss badly, doesn't really paint a pretty picture for retailers this week, and we'll see how that moves our markets. Now, a lot of you have been asking, well, why do we keep going over so much economic data and repeating that data, it seems like every few months? The reason is, when you go to the doctor and you go in for, let's say, a broken bone, what do they do automatically? They test your blood pressure, they test your weight, and they go through the vitals. Essentially what we're doing here on Monday Morning Must Knows is looking at the vital signs for the markets. And really, it's the economic data that represents those vital signs for our markets. And this week, we've got 2 very important pieces coming out. Let's start things off with the core PCE Price Index. Now, this one's extremely important because, as we know, I've mentioned this many times, the Fed has pretty much said this is the inflationary measure that they are looking for with regards to their rates. And, of course, we're hearing about raising rates 50 basis points at the next upcoming FOMC meeting. What does that mean? Well, right here you can see a red line coming across. They're expecting this core PCE Price Index to stay at 0.3. This is important because if it deviates from 0.3, which is the expectation, we could see wild swings in the markets in anticipation of what the Fed may do. Now, if it stays at 0.3, you'll still get some waves in the market as people are speculating on direction, but it'll probably mute it. Now, if we get something, let's say 0.4 or 0.5 on that core PCE price index, that means inflation is much higher than expected and the Fed will be more aggressive, and maybe, just maybe, we get that 75 basis point increase at the next meeting, which is a long shot. Or, on the other side of things, what if it comes out at 0.2 or 0.1, showing that inflation has been put at ease and everything's going to be fine and dandy? Well, then the market will anticipate that the Fed's not going to raise 50 basis points, maybe it's only 25 basis points, and therefore the market may have a nice rally. So a lot of important moves could stem from this announcement on that core PCE price index, which represents inflation. And finally, we'll talk about gross domestic product. It sounds like such an ominous word. GDP is what we're looking at. Not only that, it's the preliminary GDP, which is the first reading of it. Now, quarter over quarter, I wanted to show you this chart here because I think it's very interesting. Thursday at 8:30 a.m. Eastern Standard Time, 1 hour before market opens, we get our preliminary GDP number. Now, as you'll notice here, it's slowly drifting down, and on the hard right edge there, it's actually gone negative. The last one was negative 1.4, meaning a contraction in GDP. Now, the typical definition by most economists about GDP in 2 consecutive negative quarters, that's the definition of a recession. Now, that is not the true definition, but that's what the media loves to use. Well, we already had one, and expectations are that our next printing of GDP is going to be negative, which means, let me see, 2 consecutive quarters of negative GDP means the media is now going to start to tell you, we're in another recession. Lo and behold, here we go. Let the negative freak-out speak start by all the financial institutions. That is what is probably on slate for Thursday. But there's another chart to look at here, and that is the long-term impacts of GDP. As you can see here, it looks significantly different than the previous one. You're like, wait a minute, Merlin, why am I seeing a number of 7%? Because this is annualized. Over the past few quarters, it's been actually really good with regards to GDP. We just had the previous quarter negative. So you can see it's up there at 7. The expectations are, though, we're dropping significantly to where that little red arrow is, and if that does happen, a lot of negativity will persist in the markets and fear may start to set in. That, my friends, is your Monday Morning Must-Knows. We'll see you next week.